Let's be real. Startup funding can feel like it's written in an alien language, right? Well, today we are decoding one of the most popular and honestly most misunderstood tools in venture capital, the SAFE agreement. We're going to break down the geometry of safes using a super simple real-world analogy. No finance degree needed, just pure visual logic. Let's get into it.
Okay, picture this. You own a prime, undeveloped piece of land, and right now, as it sits there, it's worth exactly 10 crore rupees. Suddenly, an eager investor walks up. They see the massive potential here and make a totally straightforward offer. I want to buy 20% of your land today, and I'll hand you 2 crore for it. Now, mathematically, that makes perfect sense for today's value.
But, hey, you're savvy. You know exactly what's coming to this neighborhood. So you look at the investor, take a breath, and say, actually, no, I'm not selling right now because I believe this land will be worth way more next year. You are holding out for that future value. And boom, right there, that creates our central conflict. You absolutely won't sell, but the investor desperately wants in on the ground floor.
So, faced with that rejection, the investor is at a crossroads with two diverging paths. Choice 1, walk away, keep their 2 crore, and just wait to see what happens. Or choice 2, sign a SAFE agreement today. These are two completely different strategies that lead to, well, wildly different outcomes down the line.
Let's look at choice 1, wait and see.
If the investor decides to just hold off and buy in next year when you're finally ready to sell, well, in the fast-paced startup world, waiting carries massive risk. Fast forward exactly 1 year. A brand new highway gets built right next to your property, and your land's valuation absolutely explodes to a whopping 100 crore. Now, our patient investor comes back with that same 2 crore in hand. But the math has changed, hasn't it? At a 100 crore valuation, that 2 crore doesn't buy 20% anymore. It buys a measly 2%. By waiting around, their buying power literally evaporated.
Now let's pivot to choice 2, the SAFE agreement.
What if, instead of getting crushed by that huge new valuation, the investor used a clever financial tool to lock in their early advantage? In plain English, a SAFE agreement is basically you, the landowner, saying, look, I won't sell you the land today, but if you give me the cash right now, I promise that when I do decide to sell, you get to buy in at a much lower price than everybody else. It's essentially an IOU for future ownership. It rewards the investor for providing capital long before that highway was ever built. To actually make this work, SAFEs include a specific mechanic that acts as the investor's secret weapon. Let's say you both negotiate a valuation cap of 20 crore. Think of this cap as a mathematical ceiling. It guarantees the investor that when their money finally turns into ownership, their slice of the pie is calculated as if the land is worth a maximum of 20 crore, completely ignoring how high the actual value might have skyrocketed.
And you can see exactly how this plays out. When your land hits that insane 100 crore valuation, new buyers coming to the table have to pay full price. Their equity reward is standard or relatively low for the cash they put in. But our SAFE investor, their shares are assessed at that 20 crore cap. Because their valuation is capped so much lower, their initial investment converts into far more ownership than anyone investing at the current 100 crore mark.
Honestly, looking at that math, it almost feels like a cheat code, right? Which really begs the question, why would an investor choose a SAFE instead of just buying the 20% equity upfront on day one and being done with it?
The answer is surprisingly simple. Because buying equity today isn't even an option. Remember your initial rejection? The founder simply isn't selling shares yet. They refuse to put a price tag on the company right now because they know that highway is coming. The SAFE gives the investor a rare loophole to bypass that roadblock, get their money in early, and get properly rewarded for taking a massive risk when the future was totally uncertain.
Which brings us to a total win-win scenario, and why founders actually love SAFEs.
We get why investors love this setup, but let's flip the perspective entirely. Why on earth would the founder give away such a huge advantage on their future success? Well, for founders, SAFEs remove a ton of friction from the funding process. First off, you can raise money incredibly fast. You don't have lawyers arguing for months over exact percentages. Second, founders get to delay pricing the company until a much later date when their success is undeniable. And third, because of all this, it lets them just focus on building the business. The money hits the bank, and they get straight to work building that highway.
So the absolute crucial takeaway here is knowing exactly when to use this tool. As our source material lays out, if a founder is actually willing to sell equity right now and price the company, most investors prefer standard equity. It's clean and direct. But if equity's off the table because the founder is holding out for a bigger valuation, a SAFE gives early believers the absolute best deal without having to just wait on the sidelines.
We've just unlocked the geometry of safes and saw exactly how they reward the earliest believers in a business. But venture capital is literally packed with these wild mechanics just waiting to be decoded. Ready for more startup funding explained with simple, real-world examples? Because once you see the logic visually, this whole financial ecosystem actually makes perfect sense. Keep exploring, keep learning, and I'll catch you in the next explainer.